Alright guys, welcome to the channel. So this video is an interesting one. It's going to be talking about leverage, and it's something that a lot of traders, they struggle with, whether they're new or existing, and they just can't seem to get their head around it a lot of the time. So I've put together a structure that will help you visualize it in some more, day-to-day examples and help you understand what leverage is, some of the pros, some of the cons, and some things you really need to know before you start trading with leverage. So in effect, leverage is the broker lending us money. So with a smaller amount of capital, we basically put that down as a deposit, and the broker then allows us to control a much larger amount of capital so that we can earn more money off of the trade. Because in the Forex market, the price doesn't move a lot. There's only really small tiny movements in price every day, and if we want to capitalize off of these little price movements, we need to control a much larger amount of capital. So what the broker does is they allow us to control a much larger amount of capital with a small deposit. So an easier way to understand this is if I put it into an example, more of a day-to-day example. When you go to buy a house, you're rarely going to put the full amount down on the property. Generally, you'll go to your bank or your mortgage lender, normally your bank, and you'll go, let's say, I don't know, what's the average house price in the UK? About 250 grand, right? For a house in the UK. Now, rarely people are going to go to their bank with £250,000 and put that all down on a property. So in the UK, a standard deposit for a house is around 10%. And 10% of £250,000 is £25,000, right? So what we do, we come along and we put £25,000 down as a deposit on the £250,000 house, and then the bank will give us the money to then go and purchase this house. So for £25,000 we have been able to leverage £250,000, right? 10 times our initial deposit. Right, so where I live, house prices are said to double in 10 years, roughly 10 years, right? Obviously there's some variables on that, but for the sake of this example, we'll pretend the house price doubles in 10 years. Obviously this is the value of our house, and over 10 years, the house price doubles, okay? So this is the value. We brought it at 100%, we brought it at 250 grand, okay? And over 10 years, the house value has gone up to £500,000, right? That is a £250,000 increase, £250,000 profit with £25,000. So we was able to purchase a £250,000 property with £25,000. That gives us a leverage of 10 to 1. That is a 10 to 1 leverage, because this amount, the amount we was able to borrow, is 10 times the amount that we had to put down. So we was effectively trading at a 10 to 1 leverage. Now, why is this important and how can it help? If we didn't leverage our money and we just took the £25,000 that we put down on the property, and that £25,000 doubled in 10 years, we would only have made £50,000 profit. So as you can see here, £25,000 doubled over 10 years is £50,000 with no leverage, right? But if we leverage our money and we put £25,000 down, are able to control a much larger sum of money, which then doubles over 10 years, we stand to make a lot more money, right? As you can see, the difference between £50,000 profit or £500,000 is a 10 to 1 leverage. And this effectively is what happens in the Forex market when we use leverage with our broker. We put down a small amount that's called margin. So that is our deposit. The margin is our deposit. And then the broker allows us to control a much larger sum of money to trade with. All right, so how much leverage do you need to trade Forex? So this is going to depend on, account size, how aggressively you want to grow your account, the type of broker you're using, whereabouts you are in the world as well. If you're using American brokers, I believe they're capped at 50 to 1 leverage. Now this is still quite a high amount of leverage, okay? Other brokers are going to give you 100 to 1, 500 to 1, 1,000 to 1. Obviously, this is all going to depend on the type of broker you use and how aggressively you want to grow your account. But just be aware, the higher you go on, in terms of leverage, the more risk you've got on the back end. So it's a double-edged sword. Just because you can earn more money, you can also lose more money as well. So leverage just amplifies the moves you're taking in the market. So say like you was using leverage on a 50 to 1 and your equity curve is looking like this, okay? Your equity curve is nice and slow and steady and increasing over time with a 50 to 1 leverage. If you was using, 500 to 1 leverage, these swings are going to be massive, right? And obviously there's the potential to earn more doing it this way, but there's also the potential to lose more. So if you hit a natural drawdown, which every trading system will have drawdowns, right? And you're losing a bit at 50 to 1, and if you was trading at a sensible amount, you would have come out of this drawdown, but you was using a much higher leverage, too high for your account, then this swing is probably going to look like this, and it's probably not going to take many trades for you to blow up an account and get it down to zero. So you want to manage your risk. There's ways and techniques to do this, and this all comes from proper risk management, proper money management, proper testing, and knowing your numbers. And we'll get to this later on in the series. Okay, so the other thing you're going to want to know is when using leverage, you're going to incur overnight costs, right? And this is effectively an interest rate. So if you was to go to the bank and borrow money off the bank, you would have an interest rate. When you borrow money off of the broker, you have an interest rate. However, this is substantially lower than an interest rate you're going to be paying with a bank. The costs are very, very, very minimal for the amount of capital that you are controlling. And obviously this is going to vary from broker to broker. So make sure you just check that out and you're aware of how much you are being charged for the leverage you're using. Alright, so I don't want you to get overwhelmed by this stuff. I just wanted to explain what leverage is, how it works, and why we need to use it in the Forex market. There is different tools and calculators that we can use that help us calculate this stuff when we're actually trading, so we don't actually have to sit here and do loads of multiplication and addition and all the rest of it. You don't have to be a math genius to do this stuff. It's good to have a solid understanding of how this stuff works, why you're using it, what you're using, and the risks, the pros and the cons, and the risks of what you're using. But don't let it overwhelm you. Carry on with this series and it will become a lot clearer as we move through into the charts and into some more examples. Right, just to elaborate a bit further on the downsides of leverage, let's use the housing market for an example again. So let's take our £250,000 property that we put £25,000 down for, and we'll say that the housing market has dropped and our house is now worth £200,000. So that is a £50,000 loss. However, we only put down £25,000. So even though we've put down £25,000, the value of our property has gone down £50,000. So we've lost more than we originally put down. So this is the thing with leverage. You can lose more than you originally had. Now in Forex, it's ever so slightly different because you've got this thing called margin calls. So as soon as your account goes to zero, bang, that's it. Get margin called and you're out, account blown, right? This didn't used to be the case. Now I don't know if some brokers in some parts of the world still don't honour this, but I'm pretty sure now it's regulation. Obviously just check with the broker you use. You're going to want to ring them up and find out exactly, all this sort of information. But obviously we don't want to get to that scenario, right? So there is systems and strategies and risk management. It's contingencies that we can put in place that allow us to manage our risk and let our profit run and growing our account as efficiently as possible. Alright, so let's say we've got a 10 grand account, right? It's pretty realistic for most traders. So we want to risk a 1% risk on a certain trade, okay? So 1% of £10,000 is going to be £100. £100 is 1% risk on our 10 grand account. This isn't a massive lot size or amount of units needed to start this position, so we're not overly leveraged, right? We're managing our risk. We're only risking 1% of the account, and we're not too highly leveraged because starting a £100 trade on a 10 grand account isn't going to require a massive amount of leverage from our broker. So obviously the more that you risk per trade, the quicker in a drawdown you are going to blow your account. and we don't want that. So if you watched the previous video I did on what is a pip, you might have noticed that halfway through that video I was interrupted with a trade setup. Now this trade setup was on the Euro US dollar, so the currency pair that we have here. And the exact trade was this trade here, okay, so this candle. So our entry into the trade was here, after this candlestick, this pin bar. Let me just zoom into this so we can get a better idea, right? This candlestick here, this green one where my cursor is now. Our stop loss, which we need stop losses in order to limit our risk, okay? Our stop loss goes above the session and our entry was here. Now this red zone is, we're gonna, for the sake of this example, is gonna be 1% risk on our account. So that red zone, if we lose, we only lose £100. So that's, you know, we're not overly leveraged, we're managing our risk correctly, right? And obviously if we was trailing stops behind each of the session, which, you know, don't worry too much about the technicals, we're going to get into that and I'm going to teach you all this stuff as we go on. But let's say we're trailing stops behind each candle, each session, right, each hourly session. So we trail it there, and then price reverses and takes us out, right? And if you can see, the risk reward ratio says 3.0. So it's a 1 to 3 risk reward. Right, so our risk was 1% and our reward is 3%. So on this particular trade, we would have made £300. And obviously it's a very sensible risk. It's within our risk tolerances that we found out from our testing, which again we'll get into later on. But let's say we risked, I don't know, 10%, right? Which I do not recommend anybody ever risking 10%. Obviously you can do what you like. It's completely up to you how you trade. But me personally, I wouldn't do it. Now, if we was risking 10% of our account on this trade, then instead of making 3%, we would have made 30%, right? And then this would have been £3,000. So as you can see, we've leveraged our profits, but obviously if we was to lose, instead of losing 1%, we would have lost 10%. So, you know, it's a double-edged sword and there's pros and cons to using leverage. You just got to make sure you understand what you're using, how you're using it, and you're managing your risk correctly into your own risk tolerances. Alright, so that's leverage. I hope you got value from this. If you did, drop us a like. And if you're unsure about anything, then let me know in the comments and I'll be sure to help you out or do another video if I have to. I know this can be, at the beginning, quite hard to grasp, but as we move through, I've got some good tips and strategies and some good tools and calculators and etc. that are really going to help you and improve your accuracy and your performance in this area with managing risk and things like that. So make sure you stay tuned to the channel, hit the subscribe button if you haven't already, turn the notification bell on so that you're notified anytime this playlist is updated. And if you are unaware, then this video is a part of a series I'm doing where the idea of it is to help you go as efficiently as possible from novice to consistently profitable trader. So if you like the idea of that, then check out the next video in the playlist.